Welcome back. On today's video, we're talking about something that a lot of people aspire to do, and that is own a home at one point in their life. So an obligatory disclaimer here is I am not a financial professional. I am not giving you financial or real estate advice. This is based on my experience and what has worked for me and others that I know. So let's jump right in. The first thing that I did, I took a look at from census.gov, the median household income in several sectors across the country. That would include Miami, Charlotte, North Carolina, Kent, Washington. Kent is a suburb of Seattle. I specifically picked a suburb because Seattle itself is not that large and the incomes are skewed. And then I took Denver, Colorado. And the reason I was looking for median household income versus the average household income, and most people probably already know this, but the median is what's the number in the middle, excluding outliers. So if you have people with a very high number on the one side and a very small number on the other side, we want to make sure we're getting what the average person actually makes and not have it skewed one way or the other, where you can see this here. So the median picks the number in the middle, or it averages the two numbers in the middle. If you're off a little bit, the average averages everything or takes all of the numbers and averages it. And in some cases it'll come up high, in some cases it'll come in low and not be representative of the overall population. So I took the median household income, and on census.gov you can actually filter this down. So let me go over to the next tab. Filtered it down by what I was actually looking for. So that's median household income and the average housing units. And you can see here on this, it gives you a lot of great information. For example, it gives you the median household income. And again, this is not the per capita income or the income per income producer. This is who's in the household. And then it also shows you the median value of owner-occupied housing units. Something I did find very interesting was in Miami, Florida, the median income was almost $60,000 a year. The median value of a owner-occupied home was $475,000. That is quite a delta. And in Miami, if you were at the median house or the median income limit, you're probably not going to be able to find a house that's very affordable. There are some tips and hacks that you may be able to find, but if that is a goal, you've got one of two options. The first one is find out how to get your income up, and that would be generally improving your skills, finding new jobs, becoming exceptional at what you do. That's a whole separate video, and we don't need to worry about that in this video. Or find a multifamily home or a fixer that you can put a lot of effort and sweat equity into to get yourself into that. Or you can move to a different market, which is an option. It's a difficult option, but it is something that you can do to be able to afford a home. So let's move on to the next city. And we'll do this simply because this has more of an affordability matrix that we can look at. The median income in Charlotte, North Carolina is $78,000, give or take. And median property value, $351,000. That's a much more attainable market. And so with that said, if you are in that, then we need to do some simple math. So let's start with number one, how much income can you allocate towards your housing to be able to get a loan? So I did a quick search, and you can also do a little bit more in-depth research, and I've done that. And some quick research says the general maximum debt ratio that you'll be able to have to afford a home is 36% of your income. Now, how does that work? Well, let's bring up a calculator here real quick. And so the median income in Charlotte is $78,436. So $78,438. We're going to divide that by 12 to get what we can allocate monthly. So that would equate to $6,536. Now, when they're looking at mortgage calculations, they're not taking out taxes and figuring out what your groceries are and other pieces. They're looking at your gross income on your W-2 or on your tax returns if you're self-employed. So you would take that $6,500 a month times that. Let's get back into the Fannie Mae debt ratio limits. And you'll see here it says 36%, but it can increase to 45%. It can actually go up higher than that if you have a strong file. And that strong file would be things like a lot of reserves, good job history, good payment history, not a big change in the payment shock that you're receiving. And payment shock is what are you paying for your current rent or your current mortgage versus what are you paying now for the new mortgage. So let's just take this at a reasonable level. Let's just take this at the bottom level here, 36%. So $6,500 times 0.36 to get what is 36% of your income, and that is $2,353 per month that you could use for a mortgage payment. in that, you need to pay your taxes and insurance. So when you buy a house, you're going to have property taxes, and you have to have property insurance for a bank to be willing to lend on it. So they will count all of that in your monthly payment. So we're going to put a pin in this $2,353, and we're going to hop over to Zillow. Now, with Zillow, what I did is I just did a search in Charlotte, North Carolina, and I broke it down by two types of houses: your standard houses and multifamily. I don't want to look at townhomes or condos in this market, but I'm just looking at the homes and multifamily. And I sorted it by price, low to high, to see what comes up. If you remember, when we looked at this, it said the median price was $351,000. However, we're getting a lot cheaper houses in here. You'll find that in most markets, and especially in a market like we have today, which is more of a buyer's market, meaning the buyers have more leverage. Generally, you're getting more price discounts. We're seeing price cuts. We're seeing more seller concessions. You can find homes that are less than the median value. Some of these will be in bad areas, and you don't want to typically buy a house in that. When I'm buying a house, especially if I'm buying my first house or something I'm going to put equity into, I want to buy the worst home in a nice neighborhood, or something that needs some work that not everyone's going to be interested in, but I want to buy it in a place that is where people want to be, and those are usually places with good schools, low crime, etc. And so let's just look through here. We've got a few different houses, and what I might find is within the city limits, I might not find something that I'm terribly interested in. So within Zillow, I'll also come in here to remove the boundary. The first few homes that I owned, I had to drive between 30 minutes to an hour and a half to work every day, simply because I could get a better value outside the market that I was living in. And it was worth it to me to drive that far. So if we look here, we did bring up a whole bunch of new homes in different areas, and we can start filtering by what looks good to us. Now, I probably want to be a little bit closer in because I don't want to drive 2 hours on this. And let's just take maybe this house right here. Let's just click on that, bring it up. It's a 2-bedroom, 1-bath. It looks like, based on the realtor's comments, it doesn't need a ton of work to live in. It will need some updates. So let's take this one. This looks decent. It's not your new home, but it is about half the price of the median value. It has a fireplace. It's going to need some work. It may need some new carpet. I don't love wood paneling, but when you learn how to do either painting or drywall yourself, it's not terribly hard to do. The shower looks like it's functional, but it will probably need some updates at some point. But let's just take this house. So again, comparing it to the median value, $351,000. This house is currently for sale for $185,000. It looks like, excuse me, had a bug that I caught over Christmas. It's been for sale for 71 days. And it's had 49 saves, which means it's been out there and you could probably get some price concessions on this. 2 bedrooms, 1 bath. The Zillow estimate is $181,000, so it's selling for less than the estimate. Don't take that as gospel, but this means that you can look at the area, look at the market, and find out that maybe there's some equity in this house if you're able to do some work to it. So let's go back up, and what I want to do is figure out, can someone making the median income in Charlotte, North Carolina at $78,000 be able to buy this house? So Zillow gives some other good information. It gives us an estimate here of what your mortgage payment will be, but that's not the whole story. So we're going to zoom down a little bit further in this, because Zillow gives you the ability to customize your payments, and you don't have to know how to use a mortgage calculator. So this tells us that based on Zillow's quick and dirty numbers, your mortgage would be $1,383 a month. Well, that's less than $2,300 a month. So let's look in the numbers a little more specifically. This is assuming you buy the house for $185,000 with a 5.19% down payment. Now, Fannie Mae, Freddie Mac, the government programs, or the typical bank loan, will do a loan with 5% down. There are also some bank programs out there with 1% down. But also the FHA program will generally let you buy a house with 3.5% down. There's some funky numbers behind it, so work with a good loan officer on figuring that out. But if we do this, then let's look a little bit further. So let's say we're buying a $185,000 house. That would be a $6,400 a month down, or $6,400 down payment. Now, that does take some saving, but a lot of people will be able to find out how to save $6,400 over the course of time. The interest rate it's calculating is 6.84. That is probably pretty close to where I've seen interest rates recently on a 30-year fixed loan. It will have mortgage insurance, and your mortgage person can walk you through that. That's just some insurance that you have if your loan to value is above 80%. And it's assuming your property taxes are only going to be $1,240 a year. You'll want to ask your real estate agent and your mortgage person if that is accurate for the taxes. And of course, you will have to have insurance. I'm going to say insurance may be higher than $672 given how insurance has been lately, so let's bump that up to $800 a year. And then let's assume that we can get ourselves a price reduction here beyond $185,000. Let's say we're able to get it for $172,000. That gives us a payment of $1,319, which is less than $2,300 and $2,353 that we could allocate towards our mortgage. So in this market, a home would be a possibility for this borrower. Now, in other markets where you would struggle to buy a home, what you can also do is come in here and look for multifamily homes. And the beauty of the multifamily home is you can also usually check with your loan officer for your program, but you can usually count your mortgage payment or count the rental income to offset your mortgage payment. So if your mortgage payment is, let's say, $5,000 a month, but you get $3,000 a month in income, and you rent out one of the units, then you're able to use that rental income to offset your mortgage payment. And it's usually a percentage of it. Historically, it's been 75% of that rental income to allow for when people move out and whatnot. But that gives you the ability to buy something else. So let's scroll through here a little bit more. And here we've got a $500,000 house. Now, can someone on making the median income afford that based on the standard ratios? Well, no, because this is assuming the mortgage payment is going to be $3,700, and you've only got $2,300 a month that they would allow you to use of your income. But let's come down here and let's look at the details a little bit more fully. Fannie Mae and Freddie Mac and FHA have recently said that they will allow up to a 4-unit purchase with their standard 3 to 5% down payment programs. Now, that is subject to change at any time. But let's take a look at this. So we've got a home that's been listed for sale for $499,000. If we're going to look at the mortgage overall, let's come in here and let's do a little bit more work. Let's look at this as a 5% down payment. I don't know where Zillow comes up with their numbers sometimes. So in this instance, you would need to come up with $25,000. That's a lot of money, absolutely. But if you can save $25,000 and get into a home that then allows you to make other people pay your mortgage, that's a pretty good deal. So 6.45% interest rate, I'm not sure where it's coming up with that rate either when our prior one was 6.8, so let's just go with 6.5. Interest rates do fluctuate, and you can watch that and lock them in when they're higher or lower. So now we're looking at, based on these numbers, I want to take a look at this, and I'm going to say the insurance is probably going to be more like $2,000 a month, just to shoot on the high side. So now we're looking at a $3,647 per month mortgage payment, which is obviously higher than the $2,353 that we're allowed. So let's take a quick look at this description to find out more about this property. So this is they say it's a multi-offer situation. Okay, so this property may be in demand, but also realtors do this sometimes when it's not. It's a 4-unit property, which means if you're going to buy this house and live in it, you can live in 1 unit, rent out 3 to other people. To find out the specifics on this property, we'd want to go look at apartments.com or Zillow Rentals and find out what the units are actually renting for. But I'm going to take about an $800 a month rental just because that seems to be pretty safe and actually kind of on the low side. So we'll bring up another calculator here to show you how this works. So if you have $800 a month coming in on 3 units, that's an extra $2,400 a month. Generally, they'll give you credit for 75% of that. So let's times that by 0.75, and that is $1,800 a month that applies to your mortgage before it applies to anything else. So here's how that works. Let's get back down here to our mortgage payment. So we have $3,647 per month. You're going to see me having a few different calculators here, and I hope this makes sense to everyone. $3,647 minus the $1,800 in allowable rental income, so minus 1,800, which gives us a mortgage payment that we have to cover of $1,847. Well, we're allowed $2,353 out of our debt ratio. So 1,847 is less than 2,300. So this is a property that if we can come up with a down payment on, someone making the median income can qualify for. And here's the trick. If you live in this house, when you buy it, you'll buy it as an owner-occupied property, and you generally need to live there for at least 1 year. Your loan documents will most often have a clause in them that say, I will live in this property for at least 1 year. After that year, though, you can move on to another house, add someone to the unit that you vacated, and generate another $800+ a month. The goal, of course, is to generate more money out of this property than your mortgage payment so that it becomes a cash flowing property and something that generates income for you every single month. But that is generally how someone in this type of a market can either buy a standard home or a multifamily property. The first property my wife and I bought was a multifamily property, and it was great because we were a young couple. We had just had a baby, and our mortgage payment when the other side was occupied was $200 per month. That was it. I hope this video has been helpful to you. If it has, please give us a like down below. If you'd like to see more content like this, consider subscribing to the channel. And if you know someone who may benefit from this type of video, please consider sharing. Thanks for being here. We'll see you on the next one.